Well, my friends of the westernized world, most prosperous, best democracies money can buy, best lifestyles, right? The American lifestyle, the Westerner or Western world lifestyle, right? Because you could go to these other westernized countries, our buddies, our allies, and you could live pretty much the same kind of lifestyle there. And in some of them countries, you even get free healthcare as part of the deal. Of course, you get higher taxes, but they got free healthcare, right? So let's take a look at one of those countries that's boasted about their free healthcare forever. No offense to my northern buddies in Canada, but we can talk about Canada today. There's a little issue that happens, or maybe I should say it differently. When this particular thing happens, you can go ahead and start nailing the nails into the coffin of your country, your economy. It's just at that point when this little thing happens I'm about to tell you about, it is usually the point of no return, and then it becomes only a matter of time before the effects are felt and things have to get dealt with. And those things that have to get dealt with are completely surrounded by the economy, jobs, employment, etc. And not in a good way. And it has to do with debt being unsustainable. Now, that little thing I'm talking about is the debt to GDP ratio of a country. Once you get that debt past 100% of GDP, that is normally what is considered the point of no return, and it becomes only a matter of time before your country is finished. The more I see this stuff and I see these charts, the more it really does make sense that the club in their 1988 magazine cover of The Economist, Rothschild-owned magazine, and it showed the big gold coin and the new world currency. 2018 was even dated back then. The more that starts to make a tiny bit more sense. So, without further ado, record high household debt for Canadians. So not necessarily just GDP, but household, so in other words, not just the country itself in debt, but household debt. That would be you and me and that sort of thing, right? Earlier today, the Bank of Canada surprised some market participants by failing to cut rates. True, the loonie, which is their currency, was plunging, and another rate cut might very well have accelerated the decline, further eroding the purchasing power of Canadians who are already struggling to keep up with the inexorable rise in food prices. But there are other, more pressing concerns. Really? More than rising food prices? Oh yeah, apparently so. Like the fact that some analysts say that the Canadian dollar should shoulder even more of the burden as Canada struggles to adjust to a world of sub-$30 crude oil. In short, if Stephen Poloz could manage to drive the loonie lower, the Canadian denominated price of WCS might stand a chance of remaining above the marginal cost of production. Barring that, the shut-ins will start, and that means even more job losses in Canada's oil patch, which shed some 100,000 total positions already in 2015. Alas, Poloz elected to stay put, characterizing the current state of monetary policy as, quote, appropriate. We're reasonably sure that assessment won't hold once the layoffs pick up, and as we noted earlier, the longer Poloz waits, the longer the next cut will ultimately have to be, which means that if the Bank of Canada, waits too long, Poloz may have to rethink his contention that the effective lower bound is minus 50% or 0.50%, half a percent. While there are a laundry list of concerns when it comes to assessing the state of the Canadian economy and the impact of either higher rates, the loonie is supported but growth is further choked off, or lower rates, the economy gets a boost, but consumer spending is stifled as Canadians watch their purchasing power evaporate. Perhaps the most important thing to remember is that Canada is now the most leveraged country in the G7 countries. That's the top 7 countries of the world. You know, the G20, the G7, the G whatever. According to a new report from the Parliamentary Budget Office, the household debt to income ratio is now a whopping 171%. Which means, for anyone who is confused, that for every $100 in disposable income you can go and buy stuff with after your bills and whatnot are paid, right? And even then, some of that goes to pay your bills, by the way. Households had debt obligations of $171. How do I make $100 turn into $171? Answer, you can't. Answer, default time. Answer, bankruptcy. Answer, you just lost your house, foreclosure. Time to downsize. So here's a little chart of the household debt relative to disposable income, and it starts in 1990, and it looks like it ends in about the 2015 mark. That doesn't look too Smurf. Does that look Smurfalicious to you? No, it does not. That does not look Smurfy to me. Papa Smurf better get on top of things because this ain't looking good for Canada. But here's another chart I'm going to show you. That's the highest level in a quarter century. And it means that when it comes to household leverage, no other advanced economy does it like Canada. But we got free healthcare. Let me know how that works out when you can't even live in your house and you can't pay your bills anymore. Now, household debt to income ratios in G7 countries. We got the U.S., United Kingdom, Japan, Italy, Germany, France, and last but not least, the Whopper, Canada. Canada. 171% of GDP. That would be bad enough in a favorable economic environment with a benign outlook for rates, but it's a veritable nightmare when the economy is sliding headlong into recession and central planners are hell-bent on trying to normalize policy sometimes in the next 5 or so years. Put simply, the more debt you have, the higher the cost of servicing your obligations, and just about the last thing a grossly over-leveraged economy needs is a wave of job losses and a severe economic downturn. Brazil is facing a similar dynamic. Since 1991, household debt has increased each quarter, on average, by almost 7% on a year-over-year basis. That is insane. With the sharpest acceleration occurring over 2002 to 2008. You know, the housing boom. The PBO says in the report, in the third quarter of 2015, household debt amounted to $1.9 trillion. Now keep in mind, that little chart I just showed you, there's only 2 countries that are not at 100% or more of debt to, GDP. And that would be Italy and Germany. So that means United States, we're on that list. United Kingdom, they're on that list. Canada, obviously on that list. That's what we're talking about. Which means all of us have passed the point of no return. We passed the point of no return technically a few years ago. And I remember when I first saw it, oh my gosh, the United States GDP is just now over 100% debt to GDP ratio. I did a video on it. And here's another chart that shows the evolution of that household debt. Same time frame, 1990, 2015. You can see how it just is picking up steam. It's it's relatively a little gradual inclination. Then all of a sudden, whoa, what the hell happened here? We have 2000, right? 2004, 2007, just housing boom. This is the classic boom and bust cycle. And because of this, it is now time, well, this is GDP though. This chart could also be looked at as the boom and bust cycle. And this was technically a long booming period, if you will, even though we had some little issues in 2000 with the markets, right? Of course, 2008. Now all that has to be dealt with. That little can kicking episode. On its own, however, the debt-to-income ratio provides a limited measure of the financial vulnerability of households, the report continues, adding that what matters more for financial vulnerability is not so much the level of the debt relative to income, but rather the capacity of households to meet their debt service obligations. So I'm just going to ask a pretty simple question. If you have $100 in disposable income coming in every week, every month, however you want to look at it, and you got $171 worth of bills, how the hell do you make that work? How are you able to meet your debt service obligation? Answer, you can't. Credit card, default. New car you just bought, default. Jet ski, boat, default. Maybe your house mortgage, default. Which leads to what when people start defaulting on stuff? Which leads to a crashing of the prices of things, and most importantly, what I've been screaming for a long time now, telling you it was going to be coming, another crash of the housing market. And I said, I have to go rent for 2 years because I fought my bank on the foreclosure, lived in my house for 5 years, no payments. Fought them in court. They decided we don't want to go any further. How about we make you a nice little lump sum settlement? Will you take that? Answer, hell yes. I took it. But I know I can't go out and immediately go get a mortgage. Hell no, that's not going to happen. I just dealt with that. So I have to rent for at least 2 to 3 years, right? Then they say, well, you can get a mortgage again and whatever, right? So I told and I even said this to you guys, even if I could go and get a mortgage right now, and, silver was exploding, and you know what? Forget the mortgage. I can go buy a house cash. Or silver converted to cash. Assuming silver took off, right? That was what I'm saying. Or just to find a good deal, want to go get a mortgage, right? Either way. I wouldn't even do it right now. Why? When you know there's going to be blood on the streets, as far as the markets are concerned. And in this case, the housing market. Who in the hell is going to go, knowing this, let me go buy a house now, as opposed to let me go buy a house later when the prices have been slaughtered? Only someone who's paying attention will do this, right? Will do what I'm telling you. That's me, and that's you. So keep that in mind. Housing, if you thought about thinking about selling our house, if you're thinking about selling your house, you better sell that thing right now. If you're even considering it, you better sell that turd right now, because it's going to become a real turd. Not because of what you have or anything like that. It's because of what's going to happen in the market. That's why I've been waiting and will be waiting for the next 2 to 3 years. Not just because I got a little mortgage problem, but, background. I know the housing market's going to crash down. So imagine if while this happens, silver and gold start to really shoot up, housing comes down at the same time. I don't give a crap about interest rates skyrocketing anymore, because my mindset's going to be, how much silver do I need to sell to buy this damn house? Holy crap, I only have to sell half my silver or whatever fraction of my silver? Are you kidding me? Holy crap, this all paid off. And that's going to be the video of a century, of a lifetime, when that day comes. That'll be one for the record books of JSNIP4's millions of videos. So it says, it's not so much the level of debt relative to income, but rather the capacity of households to meet their debt service obligations. She says, correct, and on that measure, things have only been worse on one other occasion, during the crisis. As Canada's depression worsens, expect overburdened households to simply fold up under the pressure. That's when the dominoes start to fall in earnest as a cascade of foreclosures bursts the nation's housing bubble once and for all, and as the world discovers how exposed Canada's banks are to the country's levered-up families. Concerns about financial vulnerability are particularly prominent in the current context, given the recent economic weakness and the expectation that interest rates will rise in the coming years from their historically low levels, the report concludes. Of course, if rates don't rise, that's probably even worse news for Canadian households, because it will mean that the country is still mired in recession. We close with two passages, the first from Finance Canada's update of economic and fiscal projections, and the second from Bank of Canada's Financial System Review. Canadian household debt levels also remain elevated relative to historical norms. While this is not a risk in and of itself, it does limit the contribution that consumption and residential investment can make to growth. Moreover, if there were a negative external shock to the economy, I bet something like that's not coming, huh? This could trigger deleveraging among the households holding higher levels of debt, leading to a commensurate impact on consumption and residential investment. Household vulnerabilities could be exacerbated by a severe recession that is accompanied by a widespread and prolonged rise in unemployment. This could reduce the ability of households to service their debt and cause serious and broad-based declines in house prices. That is a Big 10-4. Take care.